Welcome to Unit 5. This week we are carrying out financial statement analysis. This will help provide you with the tools to analyse and evaluate a firm's financial position and the effectiveness of its performance. It focuses on the structured use of financial ratios. You will usually want to assess the performance relative to a firm's stated goals and strategy. That is, do the ratios reflect what managers say they are doing or want to do? A ratio by itself can be hard to interpret. Context matters. To get this context, you will typically be making comparisons either of the firm over time, we call this time series analysis, or the firm against some comparison group at a point in time. We call this cross-sectional analysis. Of course, you can do both cross-sectional and time series analysis. One of the hard parts is trying to determine what makes a good benchmark firm or group of firms. One commonly used group is the industry that the firm operates in. A common starting point for a structured ratio analysis is ROE, or return on equity. It's measured as net income divided by shareholders' equity, and it scales income by the level of investment that the owners have in the firm. It measures the accounting rate of return for the organisation. ROE is a useful starting point for a number of reasons. First, we know how ROE tends to behave over time. Really high levels of ROE tend to mean revert. That is, decline to a more normal level, and really low levels of ROE tend to improve. Both of these cases reflect the effects of competition in an industry. Really high levels of profitability attract competition, which eventually drives down ROE. Firms with really low levels of profitability either improve their performance or exit the industry. The second reason why ROE is a common starting point for analysis is that it can be decomposed into components that tell us something about the three key levers that managers have at their disposal. Profit margins tell us about the effectiveness of managing day-to-day revenues and expenses. It measures how much income the firm is able to keep for each dollar of sales. Asset turnover is a measure of how effectively managers are using resources. It shows the level of sales generated from each dollar of assets in the firm. And leverage shows the extent to which the firm is using borrowings to finance its resources. Each of these ratios can be further decomposed to provide useful information. Different measures of profit can be used to compare sales. We could use gross profit, net operating profit, or net profit as the numerator. A common-sized income statement sets all income statement line items as a percentage of sales. This allows analysts to quickly track how various expense items have been changing over time for a firm, and also allows us to quickly compare firms of different size. We can also decompose asset turnover into various categories we might be interested in. This could include inventory turnover, accounts receivables turnover, and payables turnover. These measures can help show us how quickly a firm is able to sell things, get their money from customers, and pay suppliers. There are many ratios that you can use to evaluate leverage. Ratios focusing on the capacity to pay short-term debt or liabilities are typically known as liquidity ratios, and those focusing on long-term debt or liability are referred to as solvency ratios. You'll see specific examples of all of these ratios in the course materials. The ratios that you focus on will be driven by the underlying goal of your analysis. It could be to understand the historical operating performance. It could be to evaluate the firm's strategy, to evaluate management's decisions, or to help forecast future outcomes. Ideally, your ratio should have some economic logic linking the numerator and denominator, and that there is consistency when measuring the numerator or denominator.